Again, welcome everyone who's just joining us. My name is Joseline Nicholas, and I'm a realtor in this area, and I will be hosting the webinar tonight. If you have any questions, please feel free to put them in the chat box. We know that some questions were submitted ahead of time, and we have those. We'll get to those questions first, but if you have questions, please feel free to ask them. This webinar is being recorded, so we'll have a recording available. We actually have a YouTube channel. So if you go to YouTube and search my name, Joseline Nicholas, you should see a list of all the webinars we've been doing over the years. We've been doing this for the last, maybe I'd say 4 or 5 years, where we've been hosting webinars, educating people about real estate investing, but also just teaching everyday buyers and sellers more about our real estate market in Ontario. So if you'd like to see more of our webinars or to find a recording of this webinar, you can find it there on YouTube. I think we'll also send it out to our attendees. My name is Joseline Nicholas, like you've seen. I'm a realtor in the Kitchener-Waterloo, Guelph area. I'm also a real estate investor. I actually started my journey in real estate as an investor. I had a full-time job working as an economist in the public sector. And while I was working full-time, my husband and I were buying properties. So that's how we got started. We own properties in Kitchener-Waterloo, Guelph, and Hamilton area. In the past, we've also invested in the Niagara market. So that is also a market that I'm familiar with. I went to McMaster University for my undergrad, and I went to Laurier for my master's in economics. So I'm very familiar with those two cities and 2 universities, especially today because we're talking about student rentals. So those are the 2 universities that I went to. But now I live in Guelph, so I get to spend time around the University of Guelph as well. So if you have an interest in any of those markets, Kitchener-Waterloo, Guelph, or Hamilton, please let me know. I know all those streets because I live there myself, and now I live in Guelph. Okay. So I'm very passionate about helping buyers and sellers and investors alike make informed decisions. What I mean by that is when I was an investor, before I got my real estate license, I had to search for a realtor who understood the numbers, like making sure that your properties are cash flowing. In fact, today I'll show you 4 examples of properties, real examples of deals that my clients have done, and one that's coming soon that we can run numbers on to make sure that everything we're doing is backed by the numbers. So that's my passion, to make sure that I'm committed to client success and long-term wealth building through real estate. I've seen what real estate can do for people. I've seen what it's done for me, for my clients. So I'm here to share that with you, and hopefully you learn something that you can use in your real estate investing journey. I also do acknowledge that some people on this webinar are parents who have university students, and we can also speak to that. I know that for you, you probably might not view it as an investment, but that's where I come in, and we can run the numbers to make sure that even though this could be an emotional purchase, it still is an investment. Because at the end of, let's say, the 4 years that your child is in university, you probably will still want to make a return on your investment. So as I'm running these numbers, I do acknowledge that there are parents here of university students, and that you're here to learn more about how you can take advantage of the market and invest such that when your child graduates, you've also made a return on your investment. Okay, so we'll cover a few things. We'll start with a quick market update. We'll look at interest rates, what's going on. We'll look at the affordability and home prices in Kitchener-Waterloo and the Guelph area. We'll look at demographics. We'll look at the pros and cons of owning a student rental. We'll run some numbers, as I said, on real deal examples. So these, I have 4 properties. These are real purchase prices, real. I even run numbers with some assumptions. So if you have questions on what assumptions I'm using to run the numbers, please let me know, and I'll be happy to dive deeper. And at the end, I'll show you a home search tool that you can use to search for homes on our website. Okay, so for a quick market update, right now the overnight rate is at 3%. It's been going down. The highest it was 5% a few months ago. And we've had 6 consecutive rate cuts. We've had 2 big ones. A lot of people who are on this webinar probably already know. But now we're sitting at 3% as the overnight lending rate. Rates are coming down, but not as fast as we expected. And even when we look at the 5-year fixed rates, they haven't come down as much as we had anticipated. So we're still seeing people right now, the lowest I've heard is about 3.9% for an insured mortgage, but my numbers that I'm running them with the highest, which not even the highest, but like a good higher rate, I'll say. So I'm running with 5%, but I know right now some of our clients have been able to qualify and get a rate of like anywhere from 4 to 4.5, but I'm running the numbers with 5% just to be conservative. Okay, so all Canadians know that we are in the midst of a trade war, and because of that, there's a lot of uncertainty in the market, and we're seeing that because nobody knows what will happen. And uncertainty is one of those things that definitely impacts buyer confidence. So we're seeing a lot of uncertainty, a lot of questions like what's going to happen. And the truth is, for the most part, a lot of people don't know, but we just have to look at the numbers and make an educated decision. From what we've seen, my guess, and I don't know this for sure, but my guess is that we probably will not have any tariffs in 30 days because from what we've seen, I think it's also bad for Canadians. It's as bad for Canadians as it is for Americans. So I'm hoping that come 30 days from now or 29 days left, I'm hoping that there will not be any problems and that, we'll go back to having free trade. At least that's what would be good for the markets. That's what we're hoping for, but nobody knows what will happen. We are also seeing that there's slightly lower in the last week or two, we've seen that rates are starting to come down a little more than they had come down in the last few months. So that is also a sign of like people not having confidence in where rates are going. And there are fears of a recession. And again, as I say, there's a lot of uncertainty right now. As you've seen, the Canadian dollar has been going down. Right now, I think today was around 68 cents, something that we haven't seen in, I think, 20 years, right? So there's a lot of uncertainty in the market. And I usually like to start with this slide to say, hey, I know, like before I even start talking about the numbers, I am aware of what's going on in our market. I am aware that, the economic future is not very clear, but we can still, as an investor, for me, I'm always looking for opportunities. And I know that even though the situation might not be the best, sometimes that is the best time to buy, because right now there's more sellers in the market than there are buyers, right? So it's a good time to be a buyer if we're talking about buying student rentals and buying an investment property. Okay. Okay, so when we talk inflation has come down quite significantly. In fact, in the last year, as you can see here in the graph, since January of 2024, we've been within the predicted, the target rate that the Bank of Canada is targeting, which is somewhere between 1% and 3%. So we've been, in fact, in the last 6 or 7 months, we've even been below 2%, which is something good that the Bank of Canada is happy about. So I think that the problem that we had, as you can see here in 2022, inflation peaked to 8%. That was crazy. That's something that, was unprecedented, and now it's back under control. And as a result, we've seen rates come down. Right now, what we're seeing, there's a prediction of GDP shrinking. As I was preparing this presentation, we were also like in the midst of like, okay, we don't know what's going to happen. Initially, with the trade war, we thought that by now we would have tariffs on all Canadian goods being sold in the US. But we're seeing a lot of uncertainty right now. And but all that impacts consumer confidence, and people stop purchasing things, not only real estate, but also things like luxury goods. I've seen a lot of posts about Canadians who are canceling trips and vacations and things like that. So people are not spending as much. Hence, inflation is expected to trend down. No matter what happens, I think whether we go into a trade war or not, I think that maybe Canadians will be conservative in their spending for the next year just to see what's going on and where to go moving forward. Okay. So that all that to say that inflation is under control, and we're not afraid that it'll go back up. In terms of prices, right now, we've seen stable prices. I like to show this graph just to show what's happened over the last, let's say, 10 plus years of data. The truth is, if you look at like real estate data all the way to the 80s or the 90s, you'll see that there's always fluctuations. There are always up and downs, but the general trend is upward. Like you can see here in this graph, we did have time, like another kind of like soft market in 2017. Prices corrected. There was a little bit of bubble. Prices corrected, and it started going up steadily up until we got to the pandemic times. Rates were very low and prices went up. And then in 2022, rates started going up and prices went down. So as you can see, I've had a lot of people who are saying we're waiting for the bubble to burst. If you ask me, I'd say that has already happened, right? We've seen fluctuations over time. One thing that we see is as rates go up, prices will come down. And as rates go down, prices will come up. In fact, this year, before all this tariff talk started, we were starting to see a strong market, right? We were starting to see prices come up, so to speak. Inventory levels are low. So for properties that were on market in January, even in December and November, we saw a very active market. However, with everything that's going on right now, that always impacts consumer confidence, which is why we don't know where things are going. But the truth is, if all things were equal, we probably would have seen demand go up and prices start to pick up again. Okay, so in the last 12 months, I was just looking at percentage changes in prices. For the most part, prices have been stable. So if we're looking, and I've looked at data for different regions and different cities, for the most part, prices have been stable. But I was also surprised by this for Wellington County, which is Guelph and surrounding areas, that home prices rose by 11%. I was surprised by that. I kept looking into it just to see if there's something I'm missing. But as of January, this is the data point that I had. I think probably what happened is prices had gone down so much that maybe now it's starting to come up. And as you can see here in this graph, the green or blue, I think that's green. The green line, that is for Guelph and Wellington County. And you can see that definitely the trend is shooting upwards. That's something good. It probably is an indication that things are starting to recover. But again, as I said, there's a lot of uncertainty and we don't know where markets will go next. But another thing that I like to mention when I'm looking at this data is that as an investor, I'm always looking at a long-term trend. So what happens tomorrow, yes, will impact us and will impact the market. But when I'm investing, I'm looking at 5 years or 10-year, a 10-year trend. Because the truth is, things will happen. Even if you put your money in the stock market right now, there too, there's a lot of uncertainty, right? And when I'm looking at investing, while it's good for us to be aware of what's happening today, but it's also good for us to look at a long-term trend and say, hey, right now things are unpredictable, but where are we likely to be 5 years from now? Where are we likely to be 10 years from now? One thing I've seen with Ontario is that our market is usually cyclical. So every 5 years, there's a cycle that starts. Every 5 years, there's a cycle. And we go through a cycle where things, prices pick up, they reach a certain height and they drop and then they correct and the cycle starts over again. Somewhere every 5 to 10 years, we'll see that cycle, which is like, if you look at the data that we have in front of us right now, we had one of those cycles in 2017. And you can see too that we had another one here in 2022. I'm not saying like this is for sure always going to happen, but if you're looking at a long-term trend, you're looking at 30 years worth of data, you'll see that there are fluctuations in the market. And as an investor, when we're looking at the numbers, we're not investing for tomorrow. We're not investing for next month. We're not flipping properties, right? We're looking at what's a reasonable return within a 5 to 10 year period. And in the last, if history is an indicator of that, then prices have always been higher in 5 years compared to what you bought the property for. Okay. Alrighty, so in terms of inventory, the amount of homes on market, you'll see that inventory has fluctuated up and down. Yes, there's always a fluctuation. The up and downs you see, sometimes it's seasonality. And what I mean by that is sometimes there's the lowest number of homes on market in December, and then in January, things pick up a little bit, February, March. So that's why you see the graph going up and down so much. But right now, also, if you look closely, you'll see that in 2020, 21, and 22, we had the lowest number of homes on market, the lowest inventory. That's why the market was crazy, right? It was crazy that people could just, bid on a home without seeing it, bid on a home without doing any due diligence. You remember what the market was like. So that's because our inventory levels were very, very low. But right now in 2023, 2024, and 2025, we're seeing inventory start to recover. So you can see even now in the graph that we have, gray being for Waterloo region and green being for Guelph. You'll see that Guelph has even lower inventory, but you also see that right now, the amount of inventory we have is lower compared to what we had in like 2015 and 2014 and 2013. So even though we have high inventory levels right now, it's not as crazy as it once was. I think that I say this to show that even though the media or other people out there might be speaking and saying, hey, it's, right now the market has crashed or it's the worst it's ever been. The truth is, I think, in my opinion, we've actually come back to what would be considered normal. Because what we had in 2020 to 2022, that was not normal at all. In fact, I was not happy as an agent, even being on the selling side, knowing that someone has bought a home out there and they haven't done their due diligence. Like that transaction is risky, right? But because prices were rising, things were still closing because people were afraid of missing out on the equity they've built in the last couple of months. But the truth is what we have right now is a more balanced market where the buyer has the time to do their due diligence. Demand has slowed a little to allow for opportunities for buyers to secure favorable deals. And also it's been a good time where if you have a good agent who knows how to negotiate, you can go out there and get an incredible deal. That's the kind of market we have. For sellers also, it's a good market to a point where every seller who's out there and wants to sell, homes are still selling, things are still moving. Not the only thing that has changed is the speed, right? So instead of moving like within 24 hours, things are taking like a good 14 to 30 days to sell. And then people are also having time to do their due diligence. So I'm seeing nowadays when a transaction is done, there's less likelihood of buyer's remorse or even seller's remorse. Because before, things used to happen so fast that people didn't have time to evaluate their $1 million decision. So if you ask me, I think the market we have now is actually ideal because it allows time for both sides to do their due diligence and to make $1 million decision that is well thought out and calculated. Okay, so when it comes to interest rates and like mortgage rates, it is predicted that the prime rate will continue to drop. Prime rate is usually calculated as a factor of the overnight lending rate. I believe right now it's around 5.25 or 5.2, somewhere around that. And it's been coming down as the overnight lending rate comes down, and it's projected that it will go even lower. It's predicted that it will drop by another 1.5%, which is good. It would be good for especially buyers who have the variable rate mortgages. Right now, upon renewal, in the last 6 months, I've renewed two mortgages and I took variable rate mortgages because right now, especially now that rates are going down, I just want to ride that, curve down. And then maybe I will decide to lock in when I feel like rates are going to start going up again. Talk to your mortgage brokers. That's, I guess, what I would say is talk to your mortgage brokers and see what options they'd have for you, because a variable rate mortgage is not a good option for everyone. Some people actually, like, I've spoken to clients who just want to know what they're paying every day for it for the next 5 years, and variable is not for them. But right now, it's a popular option. Another point that I also wanted to mention is that the next Bank of Canada rate announcement is on March 12th. So everybody's just waiting to see. Right now, it's too early to know what direction they will go, especially with all this much uncertainty that's in the air. So we're hoping that by then things will have cleared and we'll have a better direction of where we're going, and that, it will be a decision that's good for our economy in terms of, encouraging investments. Another thing that I should have put in here, but things are changing so fast, it's hard to have everything. But I was reading an article yesterday that was talking about how the Liberal government is going to put on hold the plans to increase the capital gain. So everyone who sold a property this year and last year, they have to pay their taxes based on the 50% inclusion rate, not the 66%. Because the 66% was not it hasn't been voted into law, I guess. So CRA cannot enforce it. And with everything that's going on with our government right now, we don't have, there's just so much going on anyway, but all that to say, the capital gain inclusion rate that was increased to 66% is not going to be the case for this year for those who sold last year, because it hasn't been voted into law yet. So I think the plans is that whoever becomes our next prime minister will then decide if they want to continue with our conversation or if they want to scrap it altogether. I've heard a few politicians say that if they win and become the next prime minister, they will scrap it. And I'm saying this because it's been a major decision making point. We've spoken to clients who don't want to pay 66%. Like, they found that was a deterrent in their investing decision. So I've been spreading the word and notifying people, letting them know that if this was one of those factors that you had to think about, maybe consider the fact that it's been scrapped and it's something that will be decided upon by the next prime minister. So we have to, that's another thing too about being an investor, is we have to be in the know. We have to stay on top of things so we know what's happening. But in most cases too, like in my case, like, it doesn't change my investing decision, because you pay taxes on money you've made. So first of all, I have to make the money before I can worry about how much taxes I'm going to pay, right? So that's kind of how I look at it. But I just wanted you guys to know that that is something that is happening. Okay, so going into universities around this area. So talking about the Kitchener-Waterloo Guelph area, we have 3 major universities and 1 college. This data here is 2024 data. I'm saying this because I know that there's a lot of things have changed with international students and, the government wanting to restrict how many international students can come. So I am aware of that, and we haven't seen how much that will impact, like, at least they haven't released numbers to tell us how much that will impact our local student bodies. But if anyone would be impacted, it will probably be Conestoga College, because they had a higher percentage of international students compared to the universities. But right now, one thing that has changed is that over the last couple of years, the universities have increased their intake of students, yet they haven't provided housing for those students. So that's one of the things that has created a crisis in terms of housing for students. An example here is Guelph, for example. Like, when I my first student rental that I bought in Guelph, rents were so low. I think we're collecting like what, 400 or 350 a room. And now a room in Guelph is, you know, depending on the condition, anywhere from $850 to even $1,000. In fact, I've seen some rooms that are going for $1,100 if they have a bathroom. Like we have buildings here in Guelph that have, you know, 4 rooms and 4 baths. So each room has an ensuite, and those are going for like $1,100 plus utilities. So that is something that has happened over the last 5 years, I'd say, here in Guelph. And it's because these universities have increased their student intake, but there hasn't been an equal amount of supply for student housing. So that has created a good opportunity, I guess, for investors, but also it's been a good, I guess, reminder for parents, especially. I'm always talking to parents. If you have a child who is going to university, you literally like paying that rent to somebody else and having your child live somewhere where you can't have control. Like if you have the means, I'd say buy them a property, teach them responsibility. I've had clients who are doing that just to teach their child responsibility to manage the property, to, of course, they're not the primary property manager, but they will work with you, they will partner with you, understand the power of putting money aside and you know, making a return in real estate investing. I have one example, in fact, of a client of mine who did that. Their child was going here to university in Guelph and they bought a property, and a few years later they sold it for profit. So those are things that I like to show parents, especially those who have students who are in university. So some pros and cons of owning a student rental. Owning a student rental is time consuming for property management and maintenance. We've had some clients who would delegate some of these things to other people, to property management companies, and you can delegate maintenance to, for example, if you need a plumber, you can get a plumber to go there. Sometimes I like to bring this slide up, but it's also similar to managing your own home. If you're a homeowner, you still have to manage your primary residence. So if something is broken, you still have to call a plumber to come and do it. In fact, in most cases, we don't do our own management on our properties because I don't know plumbing, I don't know electrical. I would rather just hire somebody who knows what they're doing and who can fix it right the first time. So those are some of the things that, you know, you'll be thinking about. And as I said, you're probably better off delegating some of those things, especially if something that you're not passionate about, you don't know how to do, just delegate it. The only thing for me, we haven't delegated property management because we're good at it. We've been doing it for more than 10 years. So we manage our own properties. I have investors who also, like, if this is your second property, you feel comfortable, especially if your child is in that property, or if you feel comfortable managing the property. I've had some clients who just manage it themselves. And if you can't manage, you pay somebody else to do it. So basically another con is for if you're getting a HELOC, some people get a HELOC or they're raising money for capital for a down payment. If you're getting a HELOC, you have to pay interest on that HELOC. So the numbers that I'm running right now and the numbers that I'll show you, I did not account for interest on the HELOC. So if you're paying interest on the HELOC, you have to do those numbers yourself. Okay. When you have a student rental, the vacancies are frequent. So the students are moving every 2 to 3 years, depending on how long their program is. In fact, I've seen some cases with Conestoga college students, because their programs are much shorter, some of them will move every year. But if your property is also located in a good area, there's always demand. So you find that every year you have to go through the process of trying to find somebody. But if you're renting to students who have a 2-year, 3-year, 4-year program, in most cases right now, we rent to second-year students because they just came out of residence. So most of them are staying for 2 to 3 years. This can also be a good thing. The frequent vacancy can also be a good thing because every time somebody moves, you have an opportunity to adjust the rents to market rents. The opportunity cost of what you could use that money for, let's say, for example, if you were to, instead of like putting it in the stock market, you're missing out on putting it on stock market. So that's also a con, something that you have to think about, that whatever you were making on the other side, you won't make it, which is why an investment has to be well calculated. And we have to run the numbers to make sure that what we're doing is a good move. And not every property is a good property. Not every deal is a good deal. So we have to keep that in mind. The odds of destruction are higher especially if you're renting to younger students, you know, the 17-year-olds who are ready to party. Not all of them, of course, are party animals, but we all know what happens on St. Patrick's in Waterloo region, right? We can't hide that. So those are all things to keep in mind, but we do have some strategies in place that we've used to control for situations like that. One of them, I guess I'll give you two examples. One of them is to rent to mature students, or to have what we call executive student rentals. And when you, an executive student rental is basically a student rental model where you're targeting grad students or international students, mature students. It's going to be a better product, nicer, luxurious home, but also it's going to be more expensive. So that's something that you can do to kind of control for just your average ready to party student. Another strategy too, you can get their parents to co-sign. And I think that if students know that their parent is on the lease, they'll be more careful, right? They won't just destroy the property as we've seen in other cases, okay? So sometimes there's also a bit of conflict among students. We've seen situations where some students will move out. Sometimes all of them will just choose to move at the same time. And sometimes the remaining ones will bring another friend to move in with them, or the one who's leaving can find their own replacement. It depends on what you want as a tenant. In the past, when students are moving, if there's conflict or somebody wants to move, we would offer an opportunity for for the other ones to see if they want to move too. Sometimes they too want to move on, but we've also had situations, as I said, where they'll just find another one to replace the person who's leaving. In some cases, when you're buying a student rental, you have to give a higher down payment. Depends on the lender. I've seen everything from people, like if they're buying it with their child, they give a minimum down payment. But also, I've also seen a place where people even pay up to 35% down payment, depending on the building you're going into. So that is basically where you have to work with somebody who knows the market, because there are certain buildings and certain student complexes that are harder to finance. Some lenders do not like certain areas that are high risk. So before you buy, definitely make sure you're working with somebody local. And before you make an offer, in fact, I like to speak to the mortgage broker just to make sure that the lender has no problem with a particular area. Because we've seen situations where like some lenders are picky and they want you to do a higher down payment. So these are all things that you need to be aware of and make sure you're doing your due diligence so that you're not finding out some of these things. Because some people find out things, you know, at the last hour, you've already committed, the transaction is firm, you don't have the down payment. That's not what we want. That is not what we're here for. We want to make sure that you're making educated decisions and that you've done all your due diligence before the transaction is firm. Okay, so some of those cons are also pros, because, for example, as I said, with frequent vacancies, you get an opportunity to charge market rents, especially with what I said, that students move a lot. In the last 5 years, like I said, rents have gone from $350 to $850 to $950, depending on the condition of the home. So if you're rented to students, they're moving all the time, then you have an opportunity to charge higher rents. You can also build wealth. If you're a parent, you can build wealth through equity appreciation and mortgage pay down. This is speaking to that parent who, instead of you paying somebody else for a place for your child to live, you can actually run numbers such that your child can even live there for free. Or if you even want to calculate for the amount that your child is paying, that can go towards paying down the mortgage faster. In most cases, you can get good cash flow. And right now in the market we're in, because rates are so high, it's hard to see cash flow. But with student rentals, the numbers work, because if you have more rooms, it's all about how many rooms you have, right? So that's the beauty of student rentals. In some cases, they're cash flowing better than homes that are rented to families. And my favorite properties are multifamily properties. And I'm still finding that some of the student rentals will cash flow better, because you can, if you have like 7 rooms, for example, you can rent to 7 different students at 800. And that is much higher than what you'd get even if you had two tenants, one up and one down. Okay, I find that students are better tenants, actually, better tenant than the average tenant, because students, first of all, they have their whole future ahead of them, right? They're less likely to default on payments, and they also get help from parents. So if you see that the students are still young and they're not as responsible, then you can get their family member, in this case, a parent, to co-sign for them. And I always find that a lot of students are not looking for trouble. I sell a lot of tenanted properties, and it's the difference between selling a student rental and just a regular tenanted property is just day and night. Most students are very kind, they're very nice, they're not looking for trouble. They comply, right? So we treat them well, they treat us well, and it's a beautiful relationship. So I really actually like students. A lot of them, I would say I've only had trouble with one student. It was not my property, it was a client's property. And this student had graduated and stayed in the property forever. So at that point, he was no longer a student, but it was just one of those like unique situations. In most cases, the students are just very good. But still, the key is we still have to treat them with respect, because I think if you treat people badly, then they will treat you badly. You know, they'll give you what you give them. So I find that students are one of my favorite profiles because they follow the rules, they're very respectful, and in most cases, they're not looking for trouble. Okay. If you structure the whole transaction well, you can correct higher rents than normal. And as I said, depends on the property, also on the condition of the property. A lot of people, when they think of student rentals, we think about like the properties that, for example, the property I lived in as a student, it was not beautiful at all, right? So that's kind of what we think about when we think student rentals. But I like to challenge you to think even to get outside the box, right? And think outside the box and think beautiful. Like if you can be that landlord who has a beautiful product, you know, you can charge a higher rent and people will pay for it. And I do have a few clients whose strategy is strictly that, to have a beautiful, well-renovated home somewhere where parents feel comfortable to leave their kids. And then you can charge whatever you want, because at that point, there's a little competition, because probably majority of the homes in the neighborhood won't look like that. So you could definitely charge a premium for having a beautiful, well cared for home. And I feel like when people come in beautiful, well cared for homes where the landlord actually cares about the property, they will also treat the property with respect. And then they'll stay a little longer because they love where they live. Okay. I also like that with students, you get predictable schedules and timelines. We know that students, majority of them move on May 1st. May 1st is that time when all the students in residence are moving out April 30th, and then everybody's moving as of May 1st. We know when they'll graduate. So in most cases, you can even schedule your leases to end certain times. You can there's just a lot more flexibility as opposed to families who are there to stay in most cases, or maybe they're not even, or they can move anywhere because of a job or something. But with students, the schedules are all more predictable. And I've also seen clients schedule the sale around the time when the students are going to be moving out. So for example, around now is when we're seeing a lot of student rentals come to market, because of a lot of the students, their leases will expire April 30th. So it's a good time. If you're thinking about buying a student rental, right now we'll have a lot of them on market, because that's the time when student rentals are changing hands. And for a parent, your child can live rent-free if the whole transaction is structured correctly. And as I said earlier, it really just depends on the numbers, and we have to look at a student rental that's ideal. Sometimes too, like with your child can get some of their friends to come and live with them. So when it comes to screening, you even get a better quality tenant because your child knows their friends. In most cases, they've already been friends for a year in residence. So then you're getting a tenant that you already know and that your child knows. So that also tends to be a good thing. Right now, there's a high demand for student rentals, which is a good thing. In fact, I remember last year, I got so many emails and so many texts of people looking for places to live. And parents reaching out saying, hey, I'm looking for student rental for rent. So very rarely will we see vacant student rentals, or like if you can't find a tenant, like unless you're looking at the wrong time. The key with student rentals is you have to respect those timelines we were talking about. If you have a place for rent in like, I don't know, let's say October, all the students have already moved and most of them are on leases. So the key is you just have to respect those timelines and make sure that your property is available for when it's available. If you're having somebody move in, for example, in October, as an example, just make sure that maybe you structure the leases to end, or you can go on a month-to-month lease, right? Just to allow flexibility, because as I said, you have to be within those timelines. Okay, so some deal examples. I will go through this quickly because I see that we are kind of almost running out of time. But this is an example of a property that my client purchased. And here, as I said earlier, I'm assuming a 5%, a 5% interest rate, 30-year amortization, 20% down payment. So with a purchase price of $585, the monthly payment for the condo, that includes the mortgage payment, the taxes, insurance, and condo fees, was about $29.65, and they had 4 rooms, 4 baths. So this is one of those that's very unique, and they could, at that time, with like last year's rent, they're charging $975 per room plus utilities, and they have a positive cash flow of $442. In fact, I think my client has a slightly lower rate, but I just wanted to use 5% just because, for argument's sake, right? I like to use like worst case scenario, you get a 5% interest rate. That's what the numbers would look like. So here you have an advantage of, renting it out per room. For 4 bedrooms, you're able to collect $3,900. Okay, so the second example here, this is actually a coming soon property. This is going to be a townhouse. It's in the Kitchener area. It's going to be probably market value is about $615. It has 4 bedrooms plus 1. So actually the 5th room is in the basement, and it has its own bathroom and a kitchenette. So the person in the basement does not need anything from upstairs. So you can even charge them slightly more, right? But I just assumed, for argument's sake, that everybody's paying $750, and this is a conservative number. Okay, so if everyone's paying, and I think the person in the basement can pay $1,000, but for simplicity, I just assume $750 per room, which is $3,750. And when you do the numbers, you have a positive cash flow of $424. So I think for sure, like the person in the basement, because they have their own bathroom, they have literally their own space, they could pay a little more and your cash flow will be higher. But I just wanted to leave it like that for simplicity. Okay, so here's another example. And as I said, this is one of my favorite properties. It's an executive student rental. As you can see, it's beautifully done. It was renovated top to bottom. And it has 7 bedrooms and 2 bathrooms. The purchase price was around $950. The monthly mortgage payment, when you include mortgage, taxes, and insurance, this is a detached home, so that's not a condo, it doesn't have condo fees. But because it's a higher price point, the mortgage is also higher. So you're paying $4,816 in mortgage payment, taxes, and insurance. And if anybody wants a breakdown of these numbers, please let me know. I just wanted to kind of give summaries here, but if you want a breakdown of the numbers, I'm happy to do that. So when you do the numbers, you're finding that you have such a good cash flow with the numbers the way they are. So that's something that it's one of my favorite strategies, because you can charge a little bit more per room just because you have such beautiful spaces. And if I was a student and I find something like this that's beautiful, for the most part, actually, there in properties like these, we find international students and grad students, or like just students from families where the parents want their child to be in a certain environment. So you're getting definitely like a premium client, and you could charge a premium for it. And those are one of my favorite properties because, first of all, you don't have much competition. If you've seen student rentals, there's not a lot of competition for that. And the second thing is the student will stay longer and they will respect the property. I've even seen in this luxury market where the landlord will send in a cleaner like once a month to just go and refresh the property, but you're charging a premium anyway, and you have such a huge cash flow, so you can afford to do things like that. Okay. So deal number 4 is an example of a property that my client purchased in 2014 because they had a child who was going to university here in Guelph, and they purchased it for $300,000 in 2014. And at the height of the market, they sold for 800 in 2022. So you can kind of see here such a huge profit. Of course, there's other things like expenses that went into it, your closing costs and things like that. But on a higher level, you can definitely see that this client made a good profit on their money. And right now, those prices have gone down. So this was sold in 2022, but right now in today's market, this is worth about 680. So this is also another opportunity for someone to buy and, hold it for as long as you need to hold it and wait for prices to go up. So I just wanted to show this as an example of what my client did. And I also wanted to show that right now this property has gone back down. It's at 680. And the monthly payment at the 680 with mortgage, taxes, and insurance is about that. There's a slight condo fee of 250 just because they have shared things like the roof and things like that. And if the 4 bedrooms are upstairs, 1 is in the basement, and there's 2.5 baths, and the rent is approximately $850 per person. When you do all those numbers, you come with a cash flow of $617. Okay, so these are some of the examples. If you're thinking right now about buying a student rental and you don't know where to start, I just wanted to give you a few steps of things that, steps that you can take to definitely accomplish your dream of owning a student rental. One is we have to look at the timelines based on your circumstances. When are you looking to buy? Are you looking to be within this cycle for students who are starting in September? Right? Or are you looking to wait and we will have to look at those timelines and confirm them. Then we have to connect you with the mortgage broker for a pre-approval, because when you get a pre-approval, then we know a budget and we can start looking for properties that fit your criteria. Once we know what your budget is, we'll do a client consultation, and then we'll start the home search and the due diligence period. Once we find the home, then we'll do negotiations and we'll help you work with you up until closing. Okay. So these are some of the steps that you can take. And of course, if you don't know where to start, just reach out to us. We'll provide our contact information in the chat box, and then we'll take it from there. Okay, so that's my presentation. I'm sorry if the last little bit felt like I rushed it. I just noticed that I only have 10 minutes for questions. So now I'm going to dive into the questions. If you have any questions, please send them to me. My team will send them to me on my phone. So if you see me on my phone, that's what I'm doing. I'm just trying to get your questions. So right now, I will just start quickly with some of the questions that were submitted ahead of time. And then I'll come to the questions that you guys are submitting. But if you have questions, please submit them and my team will send them to me on my phone, okay? All righty, so let me go to questions. Okay, so the first question is, best area in GTA to buy student rentals. Personally, I think that when we even look at the numbers in terms of like return on investment, Guelph has been a good area, right? And when I speak about this area too, I'm speaking about Guelph, Hamilton, Kitchener, Waterloo. With Waterloo, there's something that we need to pay attention to. Waterloo has built a lot of high rises around the university, so you have to know that you have more competition, and a lot of those are condos. So depending on what you're looking for, we can also look in Waterloo. But what I love about Guelph is that the numbers look better, the rents are higher, and in most cases, the prices are comparable. And in Guelph, we don't have a lot of those high rises that Waterloo has. So we definitely we have more demand than Waterloo would have. But that being said, both cities are good. You can't go wrong. In most cases in Waterloo, your purchase price is going to be lower. So we've even seen like in Waterloo, I've sold student rentals for like starting in the 350, right? So I would say that, reach out to me and we'll talk about what would be good in your situation. But also, if your child is going to Waterloo, you can't buy in Guelph. You have to buy close to where your child is, if you're a parent in this case. But if you're just a purely investor, then reach out to me and we'll talk about the numbers, okay? What expenses should I include when calculating cash flow for student rentals? So usually for a rule of thumb, I always include TMI, which is taxes, maintenance, and insurance. You can also account for vacancy. Vacancy is such a low, it's very, very low in our market. So maybe you can put like 1% for vacancy, which is like what you pay when somebody moves out. But as a general rule of thumb, that's the right. Anyway, so as a general rule, I'd say is English is not my first language, so sometimes you have to forgive me. But I would say taxes, maintenance, insurance. If it's a condo, you have to include condo fees and of course your mortgage payment. So those are the things that you should account for. If you want to know, like, what how to calculate maintenance, I can give you some of my formulas. Just let me know. And I even can give you estimates for what like taxes will be and things like that. So just let me know and I can help you run your numbers. But those are the things that I always account for. What down payment is typical for investment properties? And are there specific mortgage products for student rentals? So typical down payment for an investment property is 20%. I've seen situations where parents buy it. If a parent is buying for their child to move in, the child is on title, the child can buy it as a home that they're moving into. I've seen that too. But this is where you'd have to work with your mortgage broker to see what's best for you. If your child is on title, then yes, that's owner-occupied home, right? Because your child lives there. But if you're buying it purely for investment, minimum down payment on investment property is 20%. Should leases align with academic terms? How do you enforce them under Ontario rental laws? So everything we do is legal, like everything is legal. In fact, we go above and beyond. Just because we believe that if people are happy, if people are well treated, then they will treat the properties well, but also they will treat us well. So we've had such good relationships because everything we do is legal. In terms of aligning your leases with academic terms, that usually is a conversation that you can have with the tenant. You can choose to do month-to-month leases. So in this case, nobody is locked in. If they want to move, they can move at any time. The key thing though that I've seen is, and where you need to pay attention, is how you sign the leases with students. If you sign each room individually, that could be a problem because a lot of lenders do not like room rentals. So if you sign them as a family or as a group, that's different. And those are all things that we talk to our clients about, and not only us too, but we also like to connect them with professionals because I'm not a paralegal, but I connect my clients with people who can help them navigate those situations. So that's something for sure that you need to think about in terms of aligning leases with academic terms. It's important to know that majority of students, in fact, more than 80% of them move on May 1st. So that's something to keep in mind. And then, of course, knowing that there's an option to have a month-to-month lease as opposed to a 12-month lease. I've also seen that actually sometimes we have even like 3-year lease or 2-year leases or 3-year leases. But in this case, you don't lock them in, you just give them an option to renew the lease at the end of the first year, because I don't think legally you can lock them in for that long. But the truth is most of the things are negotiable. Like if that's what they want, most of the students too, they want to stay there for as long as they can. So some of these things are negotiable. You just have to make sure that it's fair on both sides and to also make sure that your paralegal has looked over it to make sure that it doesn't break the laws. Okay. Is hiring a property manager worth the cost, especially for out-of-town investors? If you're out of town, if you're out of province, let's start there. If an investor is out of province, yes, you absolutely need a property manager, right? Because who's going to go to the property? Like it's not worth it for you to come from, let's say, Quebec to come to Ontario to take a look at your property. So if you're out of province, for sure. If you're out of town, I have managed properties that are within an hour drive from my house. So if you're within 1 hour from Kitchener, Waterloo, Guelph area, you can still self-manage your property. Now, is the question, to answer the question, is it worth it to hire a property manager? Absolutely, it is worth it because they free up your time, right? Like how much is it worth? How much is your time worth? That's a question that I'd ask you, right? Because probably like if something is wrong, you have to drive to the property for an hour and an hour back. Like how much, it just depends, right? Depends on what you're looking for and whether or not you have the time. But also self-managing has its own benefits because you get to know your tenants. There's a one-on-one relationship. A property manager will not manage the property as well as you could have done it yourself. So that's also something to keep in mind. That also being said, you have to be careful. A good property manager is an asset. A bad one is a liability. So when choosing a property manager, we do a good job of like screening. We want to make sure that we're working with people with integrity, people who care, people who will treat the property well, right? Because not every property manager is a good one. And I want you guys to know that when you choose a bad property manager, I've seen it myself. When I started in this industry, I was working with all kinds of people, and I've seen property managers abandon leaking properties, right? They know they're leaking and they don't do anything about it. Like they're costing you money because now this property is rotting. So a bad property manager is an absolute liability. So when you're screening property managers, just make sure that you know what to look for, or you're getting referrals from people who've worked with them before and they know their reputation. And also, even if you have a property manager, my recommendation is go to your property maybe like once a year and see what's going on, right? So those are things like as an investor, you can't just let somebody else do your job. There must be something that you are responsible for too. Like you can't just let other people take care of everything, right? So to keep it short, hire property managers that are reputable through referrals. If you need a property manager in this area, do reach out. We have a few that are working with some of our clients, and I'd be happy to connect you with some of them and stay away from the really bad ones because there are some bad ones out there. Where do you find off-market student rental properties in Ontario? That's a good question. One way to find them, I guess, is through conversations. I do have a big database of clients in my office, some agents, other investors. So it's basically like knowing people. It's all about finding off-market properties, about connections. But also in the market we're in, off-market is no longer the thing that it once was. Back in the day, in 2020, from 2020 to all the way to 2022, an off-market deal was, it usually used to be good because nobody else knows about it. You can get a good deal. But right now, even we can get good deals with property on MLS. So I don't want you to think that off-market deal is still what it once was. We still have access to them, but we have opportunities everywhere. When we're looking at properties on market and those that are not on market. We're looking at everything. And to answer the question, you need a connection. You need to know people to find off-market properties. How do you maintain occupancy during summer? So that's a good question. So a lot of leases will expire on April 30th. And way ahead of time, I say even in January, we ask our tenants if they plan on staying. So if the students are planning on staying, they renew the leases. And whether they're there or not, they're paying for the summer, right? Because they're on lease for the year, right? So I'd say in January, you ask them if they're staying, and if they confirm that they're staying, you either renew their leases or you let them go on a month-to-month. And if they're staying, then they pay for the summer. If they're not staying, then they're leaving on April 30th, and you find somebody else who's moving in on May 1st, and they will pay for the summer whether they're there or not. Sometimes, just out of a kind heart, if they're paying with utilities included and all those things, sometimes we give them a little bit of a break, a little bit, like $100 off, simply because they're not there and they're not using the utilities. So we can do that, but also like we don't have to do that. We only do it because we want to, and maybe because we want to, treat them well. And we don't do it with everybody. Like you can choose and you can pick and choose, but when we do it, we make sure that they know that we don't have to do this. We're just doing it out of kind heart because we don't want them to expect it. Okay. So those are the things that we've done. But in terms of like maintain occupancy during the summer, whether they're there or not, they still have to pay. Some landlords will take on sublets and subleases. That is up to you. We haven't done it. We find that the students actually are very nice about it. Some of them are staying behind to work. Some of them are going home. Some of them, they come and go. So they just pay for the summer. Okay, so it's 8:01 and I still have questions that I haven't gotten to. My apologies, but if you submitted questions that I haven't gotten to, I will call you and answer some of these questions one-on-one. I see questions here about Windsor, Niagara, and Cornwall. There's a lot of things happening in the Windsor market right now, especially with the auto and the trade war that's going on. So that's a whole new thing. Windsor was very popular when investors were investing, like in 2021 and 2022, everybody was talking about Windsor. Everyone was talking about Niagara. The problem with those cities is like when the market corrects right now and investors are not buying, then who's buying those properties? That's the only challenge, right? It's too far from GTA. People cannot commute to work or cannot commute from Windsor to work in GTA. So we've seen that those properties that are too far from GTA have taken a bigger hit. So it's been the case for Niagara and it's been the case for Windsor because those two markets were being pumped by investors, right? So I'm very careful about those markets. I used to have properties in Niagara, but thankfully and luckily I sold before things crashed. But Niagara has crashed a lot for the same reason, because those markets were largely occupied by investors. And when investing was no longer cool, right? Everybody left, and now there's a lot of inventory in those markets. So those are things to think about. I don't know the Cornwall market very well, so I can't speak to it. Do you charge the students utilities? How do you manage? So what I'll do is some of these questions, I will reach out and answer them one-on-one just to respect everyone's time. Because right now we're at 8:03 and I'm still talking, and I'm sorry that I've taken 3 minutes of your time. But thank you very much for coming out tonight. This is why I do these webinars. There's a lot of incredible questions here, and I appreciate it. And if you have any questions, things that I haven't talked about, as I said, if you have submitted a question, I'll reach out, but also feel free to reach out to us because this is why we do this, to educate investors and to help people succeed in their real estate investing career. So without taking more of your time, I'm just going to say thank you again for showing up, and we'll be in touch soon. Take care.